Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more information about alternative investments, please visit adisa.org and check out the resource library. My name's Greg Mausz, I'm your host today, and I'm joined by Joey Roth. He's the head of distribution for Eagle Point Credit Management. Thank you for joining us here.
Thank you, Greg.
So we're gonna be talking CLOs. Not everybody knows that acronym or what it is. So why don't we start with the basics? What is a CLO?
Absolutely. So CLO is an acronym for collateralized loan obligation. A CLO is a special purpose entity whose sole purpose is to own and manage a pool of senior secured loans. In this discussion, we'll focus on larger U.S. companies as the borrowers and the underlying collateral for CLOs. And these are actively managed pools of senior secured loans, meaning this is not a static pool that simply runs off and amortizes over time. There are reinvestment periods that enable us, the investor, and the collateral manager to purchase new loans and trade in and out of loans during a certain time period. So CLOs on the left-hand side of the balance sheet own pools of senior secured floating rate loans to large U.S. companies. Okay. On the right-hand side of the balance sheet, you'll see the capital structure of a CLO. CLOs use a combination of debt and equity to fund the purchase and ownership of the senior secured loans, the assets. The debt is rated by Moody's, S&P, or Fitch. It starts at the very top with AAA, a AAA rating. Mm-hmm. It goes all the way down, AA, single A, triple B, double B, all the way down. And then there's an equity tranche at the bottom of the capital structure, which typically represents about 10%. So that's what a CLO is. At the end of the day, it is a pool of senior secured loans that uses a capital structure made up of debt and equity to fund that purchase. And it's an actively managed vehicle as opposed to a static pool that simply amortizes over time.
Okay, well, senior secured loans versus bonds. Are they the same thing or different?
Different. So senior secured loans, first of all, floating rate assets. So senior secured loans, the interest rate readjusts usually every 3 months based on the rates set by either LIBOR or SOFR. Whereas bonds are fixed rate products. As you've seen in today's market, when yields change in the market and you have a fixed rate product like you do in a bond, the value of that security can go up and down because the coupon does not adjust.
Yep, makes sense. Okay, I like that floating rate. That's good, especially considering this current market environment. So as these CLOs get structured of all these senior loans, what are all the parties that are involved?
Absolutely. So there are a handful of different parties. This is a very well-established market. There's about just under $1 trillion of CLO securities outstanding today. And the first is the investors. So we have the investors in the CLOs. Again, that starts with AAA investors, down AA, single A rated, triple B, all the way down to the equity. So different investors in different parts of the CLO capital structure. You have law firms that provide legal advice to structuring and the documentation for all the agreements that govern the CLO vehicles. You have banks that are underwriters and they are the arrangers. They arrange the financing for the CLO. You have collateral managers. They're really the day-to-day manager of the CLO vehicle. So they're trading the loans, they're assembling the pool, they're managing the vehicle on a day-to-day basis. And also you have rating agencies where, as I mentioned, the debt securities issued by CLOs are rated by Moody's, S&P, or Fitch.
Those are a lot of parties involved, but I'm guessing that's a good thing because it makes sure that these are properly structured and everything's ticked and tied, right?
Correct. You have a lot of different vetting, a lot of different parties involved, and again, this is a process that's fairly standardized over the years.
Okay, so another compare and contrast. The senior loans, the CLOs, as compared to other kind of debt structures.
Sure. So one of the things that often comes up in a discussion about CLOs is how do CLOs differ from other types of structured credit products? And we believe that one of the most important differences is the collateral that CLOs own. So we mentioned at the very beginning, senior secured loans to large businesses in the US. That's what CLOs own. If you look at other types of products that are in this broader category of structured credit, you could find pools of subprime mortgages, which have a completely different credit profile. They use some similar technology and structuring, but they have a very different fundamental risk profile attached. So one of the key principles of CLO investing and why it works, why it has worked through downturns, is that the collateral has a certain credit quality that other products don't have.
And that's great because investors, if they want higher credit quality, they can kind of access that through the CLO structure. Or if they want higher yield, they go down the risk scale and get that. But how do retail investors really access the CLO market?
Sure. So historically, retail investors didn't really have a lot of access to invest in this asset class, and it was limited to institutional investors either at the new issue market on a primary basis or through the secondary market. Today, the way retail investors can invest in CLOs is through 1940 Act closed-end funds, either traded or non-traded, interval funds, or BDCs to a lesser degree.
Great. Well, lots of different ways. That's perfect. So if you're working on constructing a portfolio, kind of where do you see CLOs fitting into the retail investor portfolio?
The most important characteristic of CLO investing from our perspective is the income orientation of the investment strategy. So it's really an income product designed to deliver high current cash flow to investors. So we see it fitting into the income part of the investor's portfolio, generally within an alternative allocation, typically an alternative to fixed income or traditional fixed income.
Well, thanks for sharing how they fit into the portfolio, but I'm just curious, what are the kind of income or dividend ranges that these funds are paying these days?
So for junior CLO securities that are junior in the CLO's capital structure, we typically see an 8 to 10% annualized distribution yield from these funds.
Yeah. Well, Joey, thank you for coming here today and walking us through CLOs.
Thank you. I appreciate it, Greg. Thanks a lot.
And thank you for watching. For more information about alternative investments, please visit ADISA.org. Thank you.